getting into our fundamental research process, we'll start with growth. So we had our macro scouting report published yesterday afternoon. Everything that's on this page comes from our macro scouting reports, and obviously our macro scouting reports are the kind of summary of all the evolution of the macroeconomic data that we're watching on the fundamental side, the policy updates that we're getting on the fundamental side, and then ultimately those projections that are born out of doing that research. That's all presented in our macro scouting report, and then daily in our leadoff morning note, it's like a bite-sized version of that macro scouting report, updating us on the critical economic information and policy information that comes out throughout the month. And then at the beginning of the next month, we have the new macro scouting report. That's really just a summary of all the things that we learned in that particular month. So it's a very Bayesian, consistent process. And again, because we're so Bayesian, because we're so consistent, it allows us to spot these critical inflections in growth, inflation, and policy in real time with enough lead time to reposition our portfolios to actually take advantage of it in asset markets. A lot of investors spot those critical inflections well after the fact because the markets have moved and the markets are telling them to go look for the information. Well, we're looking at for the information daily and are able to spot those inflections in real time in growth, inflation, and policy before the markets move. And that's why I think that's one of the reasons why, in our opinion, our clients have stayed on the right side of market risk for such a long time, or generally speaking. So getting back to growth, the latest data indicate the resilient U.S. economy theme we authored in the summer of 2022 persist. While we correctly anticipated the resiliency of the U.S. economy to begin dissipating in 4Q 2023, a sharp sudden slowdown to a well below trend growth rate is likely to be avoided. Per our fall 2022 analysis of historical yield curve inversion cycles, a recession has the highest probability of commencing in the U.S. economy in the November 2023 to April 2024 timeframe. That said, leading indicators currently indicate only a low probability of a developing recession in the U.S. economy. Japan and Canada currently have the most favorable growth dynamics abroad. China and Switzerland currently have the least favorable growth dynamics abroad. In terms of inflation, immaculate disinflation persists in the U.S. economy. Emergent signs of sticky inflation support our view that the last mile of disinflation required for the Fed to achieve its price stability mandate will be difficult to traverse in the absence of a recession. The recent surge in productivity growth in the U.S. reduces pressure on corporate margins, which reduces the need for corporations to shed costs and/or raise prices. That said, the current level of productivity growth is north of a structural trend and may not be sustained. In terms of looking abroad, China and India currently have the most favorable inflation dynamics abroad. The UK and Australia currently have the least favorable inflation dynamics abroad. And then lastly, shifting gears to policy, the Fed has implemented a dovish pivot with likely rate cuts over the next 12 months. We expect balance sheet roll-off to persist over the medium term. We expect the Treasury to offset balance sheet roll-off via its low net bond supply financing regime to avoid causing market disruptions in a general election year. The unnecessary $500 billion in the RRP and the above target Treasury general account balance represent coiled springs of U.S. liquidity that may add to the positive global liquidity impulse being driven in part by animal spirits due to green shoots globally and China front-loading stimulus early in the calendar year. While fiscal policy was a dominant driver of persistent upside surprises in U.S. growth in recent quarters, it is unlikely to remain as supportive over the medium term. Transitory factors dramatically inflated the federal budget deficit throughout fiscal 2023 in ways that are unlikely to be matched in fiscal 2024. That said, the U.S. fiscal impulse remains positive, and D.C. is unlikely to legislate a fiscal cliff in a general election year, especially with an incumbent president on the ballot. The UK and Brazil currently have the most favorable policy dynamics abroad. Australia and Switzerland currently have the least favorable policy dynamics abroad. So for those of you who are new, we update this 6 times a week. Every time you see a piece of research from 42 Macro, it's going to feature our executive summary, which summarizes that particular piece of research report. It's going to feature our quantitative risk management summary that we went over earlier. That's summarizing the output of each of our core risk management models, including the positioning model that had the signal we talked about earlier, and then our fundamental research summary, which is the update, which is the summary of everything we think about the economy from the perspective of growth, inflation, and policy as it relates to going to have a material impact on asset markets over the medium term. Anytime you see one of these summaries from us, either the quantitative risk management summary or the fundamental research summary, if you see like a highlighted call out, that just means it's changing from the preceding 42 Macro research report. So at any given time, you can just pick up the most recent 42 Macro report and understand really quickly, get up to speed on exactly what we think about the economy, exactly what we think about asset markets through the lens of our fundamental research summary and our quantitative risk management summary. And then you can unpack and dive into the information further from there.